So today is kind of going to be a deep dive on the most recent deal that I just got an escrow with the client. So I'll give like a little bit of a background about the property itself and like how I got introduced to the client and kind of like what stood out to me about this property. And then I'll kind of show like what the rent roll looks like, what the profit and loss statement looks like, and how we, like in conjunction with their thought process on the property and kind of some of my ideas about, hey, where is there some room for improvement here? Like why they thought it was a good deal. And so we'll just kind of hop into things. So the property itself is a 18-unit complex in Hayward. And the way that I got introduced to these buyers was through a lender that I just closed a deal with in Hayward. And it was another 18-unit complex in Hayward. But basically, we had closed a deal. He reached out to me a couple weeks later, and he had this client who he had done a deal with a long time ago. And they kept sending him properties that just were really like they didn't cash flow well. If they were getting financing, they were going to put 30, 40% down to make it pencil out. And so when we kind of talked, he was like, hey, you seem to find like some decent properties. So why don't you connect with these guys, show them some opportunities and see if you can find something for them. So that was great. Love to get referrals from people. I called the buyer and just spoke with them and got some information. And I think this is like one thing that I really struggle with in the beginning that I'm trying to get better at is get a really defined buy box from investors. And so for these guys, like what that looked like is they were open to location. They were investing in Santa Clara County and San Jose strictly because that's what they knew. That's where they had bought a place before. They were comfortable with that area, but they were open to other locations. The second, like a really important thing for them is that they were buy and hold investors. They're not looking for something to fix and flip. If they find value add, it's because they want to add value for themselves to hold the property in the future, not because they want to like buy it, do value add, and sell it in 3 years. So that helps when I'm looking for a property, helps me determine what type of property we're looking at. And then one of the unique things that they were looking for was they wanted all of the units to be at least 2 bedrooms, preferably 3 bedrooms, which is kind of unusual for multifamily properties from what I see. Can anybody give me a few ideas of why you think an investor would be looking for at least 2 or 3 bedroom units for a property?
So he can attract more families?
That's definitely a big part of it.
And the rent per door will be a little higher. There are fewer single people looking for rentals than couples or families.
Absolutely. And so I think the kind of the combination of what you guys said, and thanks for the feedback, is like lower vacancies, right? Less turnover between tenants. These guys are buying properties to hold them for a long period of time. So if they can attract more families and get a little bit higher rents, then they're not dealing with inflow and outflow of tenants as frequently as you would if you're owning an apartment full of studios or 1 bedrooms. And so the nice thing about that criteria that they had is it was really specific. And the hard thing about that is that it's really specific. So finding a property that's super specific is sometimes easy and sometimes really challenging, but it helps me whittle down what are the options when you have like a set of criteria like that. So that's one thing that was really helpful, was knowing, okay, these few things mean, like if I look at 100 property, there's probably going to be 3 that fit their criteria, that have 2 bed or 3 bath units or 2 bed or 3 bed units for the entire complex, and that have a decent cap rate and are like within a driving distance of Santa Clara County. So I looked at some properties, sent them over some options that I found online, and then I got an email. I'm going to go ahead. I'll share my screen real quick. So this is the email that I got from this group, and this group is called, probably some of you in my area know this group, but it's the RZ Advisors. They actually have like a ton of listings in the area. And so the way that I got on this email list is just downloading disclosures. It's not like I didn't reach out to them and say, put me on a list. I downloaded a couple sets of disclosures from them, and then they automatically put me on this list. But the benefit of that is I'm getting properties from them, and you can see kind of on the left-hand column, if you look at the coming soons, I have a bunch from them. Coming soon, 14 units in Palo Alto, coming soon in San Jose, coming soon in Castro Valley. So these are off-market opportunities until they're on the market. and they're being shopped around a little bit. It's not like I'm the only person that knows, but this is a great opportunity for me to show to a client, like, hey, these are properties and you're getting like first access to them before you can see them on LoopNet or Redfin or Zillow or wherever people are finding their multifamilies. Probably closer to LoopNet and Redfin. So when I saw this one, it stood out to me for a few reasons. One is the unit mix, right? 3 bedrooms, 2 bedrooms, 2 bedrooms. Another thing about this property is, and I don't know how like familiar everyone is with Hayward, but the city of Hayward has pretty strict rent control. So they cap rental increases at 4%. And so this property is in Hayward, but it's in unincorporated Hayward. So it's not subject to the same rent control. So that's helpful to know. And when you share it with the client, that's a very big piece of information that allows them to see, like, one, you know the area. And two, here's how we can increase rents if they are below market rate, which I do think these ones are. And then it kind of shows like a breakdown of the units. Like you've got 6 like flat style apartments in the front. And then all of these other units, and I know it's kind of small, but these are all townhouse style. So that's another thing that stood out to me, because if these guys are looking for long-term tenants, probably townhouse style is going to have a longer-term tenant than even the same unit mix on an apartment. Each townhouse has its own balcony. It has its own garage. It has a little backyard space. So I thought this was a really great fit for them. And then there's just pictures and marketing real quick. So that was kind of some of the like details. And let me hop off. I'll share again here in a second. Those are some of the main things that stood out to me about this property for this client. And as I got further into it, I saw like in-place cap rate is 6.27%, which is really good. One of my favorite things about Hayward, and it's one area where when I find good properties, and probably, I think I've shared like 4 properties on the school group, I think 75% of them have been in Hayward. And one of the reasons for that is that Hayward has really good cap rates, and you're getting, Daniel said, if it's a real cap rate, and it is. Daniel, I'll show you on their OM and their P&Ls. These guys include vacancy costs. They include current, like what the real estate tax would be at the sales price. Usually you don't get real cap rates. And I think we talked about this on a few trainings. You have to really, like, the marketing package is just that. It's the marketing package. So it's probably not like the worst case scenario. It's the best case scenario. They're painting a pretty picture of what the property could be. But that is the true in-place cap rate. So yeah, City of Hayward, I feel like, and unincorporated Hayward, you get like Oakland and San Francisco cap rates without Oakland and San Francisco rent control. And so I sent this over to the client, and it was like a really simple, super simple email. Here's the email. And I realized after like I was reading this, prepared for this meeting, that I had some weird verbiage in here. So it don't have to be perfect when you send things out to people, but just really simple. Like, this property looks good. Here's a unit breakdown. Here's the cap rate. These guys, before we started looking at properties, told me they manage everything themselves. So when I looked at this property, I let them know, like, if you remove the management fees, you could increase the cap rate to this. And then attached the offer memorandum, and then I also compared it to a property that they were looking at before that I had shared with them, and then just asked for a time to talk. So it doesn't need to be like, I didn't fully analyze this. And I think like when I've talked to Kyle and like other people about like how I first got started when looking at properties, I would analyze the heck out of a deal before I sent it over to somebody. And I wanted to make sure all the numbers made sense and like I knew it in and out. And now what I'm doing is just sending over like something really brief like this. It could be a text, but these guys respond better to email, and it's 2 partners. So that's my way to get them like together. Something simple to just say like, hey, here's the deal. Here's a couple of highlights. And if they like it, then I can send them more information and they can dig through things and get a little further. And then here is some of the due diligence package. This is the offer memorandum that I shared with them. So high level, again, it just number of units, total building, stories, building square footage, all that information, unit distribution. Other thing I really like about this property is how spread out it is. Like, it's almost an acre, and they have like a really nice, like, it's spacious. It doesn't feel crowded. It's a nice place where I can see people wanting to live for quite some time. And then they've got some photos and some floor plans. And then the important part, we get down here and we get to the financials. You got the price per unit, price per square foot, building square foot, year bill. What I really look at just before I send it to anyone is I'm looking at what the cap rate is, and what the price is. Because if it fits their price and if it fits kind of what their cap rate, like what they're looking at, which I didn't have defined here, they were looking in San Jose, which I know is like 4 to 5% cap rates. So if I could find out something better, then, why not? And then they have the rent roll detail here. And I will kind of dig through the rent roll a little bit here. But one of the things that I noticed when digging through the rent roll is because I just helped somebody buy another 18 unit complex in Hayward, and we manage that property too, is these rents are below market rate for what they could be getting. And so that's another point, like when I spoke with the client, like more and more about this property, like that I brought up, like if you just brought this property up to what we were getting at this other Hayward property, you would be able to make substantially more money. And I'll kind of show you what that looks like. And then it kind of goes over attached garages and who has assigned spaces. And then a little bit of operating statement. One thing, like when you look at this operating statement, that's going to be different when we look at the actual like P&L statement. There's a lot of things that aren't included in this operating statement because, like Daniel was alluding to, like this is a marketing package. So there's things that we'll see in the profit and loss statement that it goes above and beyond what is here in the operating statement. And one thing that these guys were looking for is, because they manage themselves, is where can they trim off some fat from the expenses? What are expenses that they currently have here at this property that they can remove themselves and maybe make more money just that way? And then they have like notes on the operating statement. So that's the offer memorandum. Kind of same rent roll. This one is a little harder to read, but I'll show you a spreadsheet that I made, and I am not a spreadsheet guy, so you will be able to, it'll be evident when you review my spreadsheet. But I just looked at the other property that we just helped someone purchase in Hayward on Huntwood Avenue and compared what the average rents were for the unit types to what the average rents are here. And so right here is that spreadsheet, and probably not done properly, so forgive me for all you spreadsheet people. So for Arbor Ave, which is these apartments, this is the average for the 2-bed, 1-bath flats, like apartments. And then this is the average for the Huntwood Ave flats. And the difference between the average for each unit is $397, which is substantial. And that's just apartment to apartment. And then when we look at the actual townhomes, the townhomes are getting a little more money, but they should be getting substantially more money. And same with the 3-bed, 1-bath townhomes. On Huntwood Ave, we have 2 3-bed, 2-bath duplex units, but the duplex units don't have a real backyard, and they also don't have a balcony. And so arguably, I think the rents should be the same, if not a little higher. So when I look at the delta between those and add it up, there's a difference in rent for the property of $68,000. And that's huge, right? And so for me to be able to go to the client and say, hey, we just signed up this other property, like 10 minutes or less than 10 minutes away. And these units that you're looking at are townhouse style. This property is in much better condition that they're looking at. And if we just brought up your rents to where this other property is, so we have, I'm not just saying like, here's a pro forma rent. You could get this. Here's what we're getting at another property. You can make an extra $68,000 on this deal, which is huge. So I thought that was, when they saw that and I was able to compare the rent rolls for them and let them see both rent rolls, I think that was a big eye opener for them, because it's one thing to speak theoretically, and it's another thing to be able to show them. And we don't have to show them like actual rent rolls from what we manage. We can also show them like the rental analysis that we have that shows what properties are actually renting for. So just real data in front of their eyes, other than just like, here's a potential pro forma from a marketing package, makes a big difference, in my opinion. And then we get into the T12, like the last 12 months of the property. And so there's a few things that stand out to me. And I know there's a lot of data to look through, but a couple of things that I notice is there's some big vacancy loss over the last year. So they had $36,000 in vacancy loss. So they had a lot of open units. To me, that's explained by the fact that they were increasing the value of the units. They were moving tenants out, getting higher rents because they were prepping to sell. And you'll kind of see that when you look at like their maintenance expenses and some of their turnover expenses, they're relatively high. And I think those are all tied together. One thing that really stands out to me is the manager's rent concession, which is $800 a month. I'll talk a little bit in a second about how we typically handle on-site managers, because anything over 16 units, right, Kyle? Anything over 16, we need an on-site?
Correct, yeah.
So anything over 16 units, we need an on-site manager. And CNC has a specific way of dealing with that. I think is a lot better than what some of these other companies are doing. And we'll kind of see that when we look at these costs right here. So managers get $800 a month in rent concession. And then that manager is also the on-site personnel. And the on-site personnel, the cost for the year, just for the 10 months of this year, was $9,182. On top of the $800 a month. And then they're also paying payroll taxes, payroll expenses, and workers' compensation on that person. So when you look at that, like in total, it's almost $20,000 in expenses for this on-site manager, which seems really high. And the way that we handle on-site management with CNC is we'll pick a unit, we'll pick a tenant, and that tenant gets 2/3 of the market rate. They pay 2/3 of their rent. And so we don't pay payroll taxes, we don't pay payroll expenses or any additional income. And then we set their duties to as minimal as possible, so we can avoid those things. And so here's another way, like when we look at this, we can show them like, hey, even if you do, let's figure you keep the $800 a month for the tenant to give them that rent concession. You can remove another $10,000 in expenses by just handling your on-site management a different way than they are. So that's another 10 grand. So now we're up to $78,000 in potential that we can have on this property. And then one other benefit that came of me having these discussions of here's how we handle management, right? You guys heard me say before that they manage all their own properties themselves. And so we never got, like, I dropped like, oh, okay, like if you need help, like we can help you with this, and then never touched on it again. But as we were walking through these P&L statements, as we were walking through the property, I was just subtly dropping like, here's how we handle these types of things. And I think it was really helpful for them, because at the end of that, the question from them was like, hey, what would it look like for you guys to manage this property for us? And for a few reasons, right? Because they're in San Jose, they're used to San Jose, they know San Jose, they don't know Hayward that well, but they know that we do. At least we know another 18-unit building in Hayward. And we know enough about the different types of, unincorporated and incorporated Hayward. And so I think like I wasn't hard selling them on management at all. And I actually thought they definitely weren't going to sign up for management, but just dropping like knowledge about how we handle things was really helpful. And it turned them into basically selling themselves on what we did for them. And then one other thing about this, and you can't really tell this from the P&L statement, but every single one of these units is individually metered. You could tell a little bit when you look at the gas and electric costs that they're super low. So one of the benefits is that each unit has its own electric meter and its own gas meter. But what they share for all the units is a water meter. And so one way, and I don't think they haven't gotten rid of RUBS completely yet, but one way that we can also increase the NOI of this property is by putting the water meter on RUBS. And then that way we kind of push that back to the tenants, with the caveat being that would count as a rental increase. So we'd have to factor that in to rental raises. So that's kind of like on the general operating expenses. And then when we get into maintenance expenses, kind of see some costs that are pretty high. Plumbing costs, we got $3,000 here, $8,000 in this month, and then some appliance replacements. So these are all questions that the tenants had, or the clients had, that they sent over to me that I then like got clarification from the seller's agent on. like, hey, what are these expenses and what are the costs there? But I let them go through that and ask me those questions. And then I'll kind of forward it to them. But I think the important part here is we see $42,000 in maintenance expenses, which seems like relatively high when you're looking at 18 units. And as we continue to kind of go down further, we also see turnover expenses at $34,000. Now, I think that owners will look at this in two different ways. If you're a buyer and you're looking at a property and you see that there's $76,000 in maintenance and turnover expenses over the last year, that could be a little scary, because that's a high maintenance and turnover cost. I tried to frame it as a benefit because these people were doing this work in advance so that they could sell the property without all that work being done. And I think that's the way that they took it. They just wanted clarification on some of the costs, obviously. But one of the important parts when we're looking at these things is framing for the clients. Because you can look at it, perception is everything. They can look at it a few different ways. So if you go into it saying, hey, this is a benefit, there's $76,000 you don't need to spend next year that they just spent on this property. And it's turnover of the units. And then they were a little concerned about vacancy. But I think the vacancy is explained by they're getting ready to sell. Right, they were getting rid of some tenants. They were fixing up the units. They were renting the units out at market rate, or kind of market rate, to try to sell this at a better price. And then you just go down, and then they have total operating expenses, net operating income, and then total income expenses and all that fun stuff. Anyone have any questions looking through the profit and loss statement? Anything that you're not sure about, or what are the key areas that you should be looking for if you're digging through this with the client? Yeah, Martin.
What would you say is an acceptable vacancy loss, like an industry standard percentage? What would that normally be?
So typically you're going to look at between 3 and 5%. And I think the lenders that I'm working with right now are going to factor in 5% on their loans. You'll see a lot of people use 3% on their marketing, but the lenders that I'm working with, they factor in 5% vacancy. They want you to have 5% reserves. And then they'll be, depending on what your expense ratio on the property is, they will make that a little more conservative, depending on what people actually have.
And what was the percentage on this particular property?
On the actual vacancy for this year, I did not calculate that. They, on their marketing package, it's at 3%, though. But I didn't calculate what their actual vacancy was. We could look through the leases. When I look through the leases and the rent roll, you'll see, I can just hop over that right now, but you'll see a lot of the start dates for these leases: May 25, right? August 25, February 25, May 25, June 25. So a lot of the people got leased up in 2025. So that explains kind of their vacancies. We could look at that and see how long the vacancies are, but it was way higher than 5%.
Now, was this property self-managed?
No, but they had 4 different managers over the last 4 years, which means one of two things. The way I said it was it's really hard to find a good manager, right? But to me, that screams an owner problem. I don't know about you, Kyle, you guys manage a ton of properties. If someone has 4 managers over 4 years, do you see that as a potentially really challenging owner?
It's usually the owner. It could be the property, but it's probably the owner.
Yeah.
Because that's a lot of work for the owner to go through 4 different people. That's the onboarding, offboarding process is the hardest part.
Yeah.
Honestly.
I used to do property management, on site, and it's usually always the owner.
If every one of your exes has a problem, it's probably you. What's the problem?
Well, another red flag that I got about the owner was when we were touring the property, they had a TV system or a camera system, and we asked the on-site manager, and she was like, "Oh, I've never seen the Comcast bill for that. I don't think those work." And then the seller's agent came over to us after he heard us ask that question. He said, "Hey, they do have a Comcast bill for that. The owner gets it paid separately because he doesn't want the management company to know that he has the footage." And I was like, "Oh, that's super weird." I don't know why he told us that, but that was red flag on the owner for sure. Or maybe he's had really bad experience with property management companies. I don't know. Maybe. But yeah, that's a good question, Martin. I think like typically what you're going to see is 5% factored in. And then if you see like large vacancies, it'll be for various reasons. I think in this case, because of the different variables that were there, when you saw the high turnover costs and the high maintenance costs, I think they were just prepping it for sale. They had some people that were below market rents. They did large rental increases and tried to get them out. They did have a eviction, but that's kind of what I attributed it to, or the way I try to like paint the picture.
It also looks like they had a high delinquency as well.
Yeah.
So I guess people that were managing it weren't doing a good job.
No, yeah. So they delinquent rent pretty high on all these months. I mean, any delinquent rent is a challenge. I mean, $102, $204 isn't a lot, but when you're looking at $5,000, then you know that's two units at least, right? Based on the rent that they're getting. So I think when they're like, the benefit to these guys is they're not looking to buy it and have the existing management stay in place. And when they look at it, they'll see some of these things. And these are at least the way that we have this discussion. And I actually really like these clients. Like we don't always choose our clients. Sometimes you have challenging people, and these guys, I like their thought process. They see these as problems they can solve. Right, here's a problem that I can solve that can make it much easier. And then they have the benefit of not taking advantage of this person's problems with the property, but kind of, picking up where someone else is like falling off. Like you don't need to be spending $10,000 a month on on-site personnel. You don't need to be spending, you shouldn't be spending, $76,000 a year on maintenance and turnover costs on 18 units. That's really expensive. And so they're looking at these things as what are the problems that this property has, and what are the problems that we can solve, and how can we add value, and not add value so they can sell it down the line, but add value so they can make more money off of it and get it at a better rate. And then these problems that we're seeing here were also things that were used when we negotiated on the deal. So things that we can point to that are concerns. And when you're talking to the client, like to the buyer, like you paint it a certain way. But when we talk to the seller's agent, it's like, hey, these guys are super concerned about this. You've got like really big vacancy costs. You have like super high expenses, and they're not sure if those are going to be recurring expenses. One other thing that I would look out for when you're looking at P&Ls, and that you look at, this is just this year. I didn't think it made sense for us to go back to 24 and 23 and 22, but when you look at these profit and loss statements, a lot of times when an owner's operating a property, you're going to see a lot of these expenses on their operational expenses. And when they're going to sell, you're going to see a lot of them go to CapEx. They'll shift them in different places depending on like what makes sense. But if they're operating expenses, they can write them off more. So some of these things that we see as operating expenses, I think, are more one-time costs that they are putting as regular costs. So after we dug through all that and we went and saw the units, we toured the property. It came on market. So this particular group will show it coming soon, and then like a week later it'll go on market, and they'll do like an open house where you can go and tour the units. And we went and toured the units, walked through the property, and before we left, I tried to determine like, how interested are you guys in this property? And luckily with these guys, we were able to craft like an initial offer on site before we left, so that I knew I could go back to the seller's agent and speak with him about it. So this property is listed at $5.85 million at a 6.2 cap, which honestly like is a good deal. And I tried to convey that. I was like, I think if you guys got this at this price, it'd be an okay deal. And anything that we get under that is going to be a benefit to us. So when we talked about like wanting to throw out a starting offer, it's not like their best and final, but what we settled on was 5.4 million, which is like pretty far off, but it's not so far off that we won't get a response. And so I called the seller's agent and told them like, hey, we like the property. We walked through it. They're super interested. They're ready to move forward. We want to throw out an offer of 5.4 million. Would your guy respond to that? Because we're 400 grand away. And he just said like, hey, like he would respond. I think like if you want to get further in the negotiations, we could probably like, if you could start somewhere around 5.5, that'd be great. And so we just kind of did that little ping pong back and forth. My client came in at 5.5, like pretty solid terms. And then they countered us. And these guys were a little challenging. I had a phone call with Kevin like after a couple of days because they were not responding to the counter we got. We submitted an offer at 5.5. We got a counter at 5.75. And they did not want to change their offer. And their thought process was like, look, these guys need us more than we need them. They like the seller needs to sell for like specific reasons. So he does want to liquidate the property. But so they felt like they were in control and they didn't have other offers on the table. And so they just waited it out. And I talked with Kevin. I was like, how do we handle this? Because I feel like if you don't respond in a counter, it puts a bad taste in the seller's mouth, potentially. Right? Because you're like, here they are negotiating a little bit. And so I try to talk with the clients and they just thought like, hey, in 24 hours, they came down $100,000. If we keep waiting, how much further will they come down? And I was just like, well, they didn't, like, they're negotiating, right? They're not just coming down because we're waiting 24 hours. They're negotiating and we're supposed to negotiate against like with them. So we kicked the ball back and forth a little bit, and then we got a little stalled, where my guys was at 5.5 or 5.55. So 5,550,000. Seller came back to us at 5.6 and a quarter. And we were at a stalemate. They didn't want to come up. They felt like they were offering a great price. The seller didn't want to budge at all. And so me and the seller's agent decided to both kick in 0.5% to get the deal done. And so I know this is a conversation we've had like many times. We did a role play about this like probably a month or two ago on one of Kevin's Thursday trainings about like, do you ever kick in a percentage on a deal if people ask you to? And my stance on that is like, I usually won't if the client asks me, because that like, I don't like that question, right? I had someone ask me recently, like what I was willing to contribute to help get their deal done. And I used Kevin's line, which is like, what makes you think that I would be the person to help buy your home for you? It didn't go over well, but it got the point across, Kevin. I like the bluntness of it. But on this deal, it's like, hey, we're right there. We're so close. You know, no one's willing to do it. I'd rather get 2% of a $5.6 million deal than get 0%, or then get 2.5% of zero. Right. So in this scenario, to me, that made a little sense. The seller's agent was willing to do it as well. And then we were able to kind of bring the deal together. We settled at 5.6 and we both kicked in 0.5%. So like, I don't know, does anyone else, like, have you run into those scenarios where you can contribute a little on your end to bring the deal across? And I'm curious to hear from the audience here. Would anybody do the same thing? Or would you all kind of stick to your guns?
No, I absolutely would. I mean, sometimes it just makes sense to get a deal done. I haven't done it on a multifamily, but I've done it on, a few other deals. And if they're too far apart, sometimes that just brings it over the line. And as you say, 2% of, 2 or 3 million is worth, is still good money. Because the way I look at it too is would you sell $1 million house at 2.5? You would. So what's the difference between that and selling a $2 million house at 2%? You're still making more money. And it's more or less the same. Not that you want to do that as a normal thing, but if you do it, I don't think it's a big deal.
Yeah. I agree with that stance. And like I kind of said as well, I did it because I wanted to bring the deal across, not because the client came to me expecting me to do it. I think that's a little bit of a different conversation, because then I show like a lot of good faith with the client. These guys are good, like they're long-term investors. They own multiple buildings, right? There's going to be more deals done with these guys. And so if I can show like, hey, I'm willing to, if I can bridge the gap with a little bit of a commission, and it's not like on our end, it's 0.5%. It's not that big. It's a lot of money. But on his end, if me and the seller's agent kick in 0.5% each, it was over $50,000. That bridged their gap pretty substantially. And then we're still like making money and getting the deal done. And who knows how long it would take to bring these guys across the table if we find another property. And there being, like I felt like it made sense on this one. And again, not something, I've only done it one other time. And the other time it was also a personal decision, not because the client reached out to me and asked me to, but more like, oh, we're so close. Like if you're really close, I think in this scenario, at least it made sense for me. And then they also will turn into a management client. And so you're building long-term relationships with these people. I think if it's a single family home, sometimes like maybe they'll buy or sell again in the next 7 to 10 years. But with these guys who are like multifamily investors and just investors in general, you're going to be doing repeat business. And so you don't necessarily want to set a precedent of like, yes, I will contribute commission to get your deals closed. But I think it shows like a little bit of like, hey, I'm a team player here and I'm like willing to like put in a little bit on my end so that we could bring this deal across the table. So yeah, eventually got into contract at 5.6 million. And now we are getting deep into the due diligence period. So other terms for anyone who's interested was 45-day close of escrow, 30-day financing contingency, and a 17-day physical contingency.
That's pretty fast for a loan.
Yeah.
45 days you're moving fast on that one.
Yeah, lender, I asked him if he, and you know what's frustrating is I was trying to do it because I'm going to Italy the 27th of December. And we were going to close before I left. And then now, because we were going to close so close to Christmas, everyone's like, oh, can we just close like the 2nd of January? And like, I don't care, but I'll be in Italy. So I'll be talking to somebody about helping me with that. But anyways, it's a quick close. And that's the way, like when we talk about crafting offers, my conversation is always like, there's ways that we can make our offer more palatable without increasing the price. And one of those ways is a quicker close. Another way is like not having an appraisal contingency. We have an inspection contingency, but these guys, we're going Friday and they're just walking through with their plumber and a general contractor. We're not getting like a big commercial property inspection, roof inspection, sewer lateral, and all that stuff. And that was part of like what they really asked us to convey to the seller was if we get into contract, like we're not going to nickel and dime you guys out of like 10,000, 15,000 a year because of a termite report. Like we're really in this to close. And that was helpful with bringing the seller down because some people, like on my last deal, they had the opposite approach. Let's get into contract at a higher price and then let's squeeze them for every dollar we can. And either approach is like, okay, I'm here to work for my clients, right? So whatever approach they want to take, like I'll do it. But this approach I thought was a little bit smoother, a little easier.
Was the depreciation a part of the decision-making factor? No,
never even talked about it. And so we'll talk about it now that they're getting into it, but that wasn't part of they just been looking for a property for a while and been having a hard time finding a property. I had to sell them a little bit on why Hayward was a good opportunity because they don't know the area very well. But I think like to me, it's a pretty easy conversation. It's working class community, really good rents outside of incorporated Hayward. You're not dealing with like rent control like that. And then there's a lot of people that are commuting. It's positioned nice because you could commute to San Francisco and you could commute to Silicon Valley. It's kind of right in between. So I think it's a really great location personally. So I had to sell them a little bit on that, but depreciation wasn't a part of like their thought process, though I'm sure that conversation will come up in the future.
How did you convey the strategy as far as, or the negotiation from the buyers to the sellers as to, look, we're not going to nickel and dime you? Was that in writing, or, how did you convey that and what was said as far as the contract?
Really a phone call with the seller's agent. And like, I always like one of my favorite things to say, because it always helps, like, sometimes when you're in a negotiation, it can feel like you're going against somebody. And I really try to make it seem like we're working together here. And so like my talk track is always like you want to get your seller as much money as possible for the house. And I want to get my buyer to buy this for $1, right? How do we find the happy medium to where we're meeting in the middle? And sometimes it's like when we kept going back and forth with counters, I was like, look, if we need to kick this back and forth again so that the buyer and the seller can feel like they put in their best effort, like let's do it, but we know where we're going to settle. Right. So I think it's just working with the seller's agent. And this is on all properties, not just multifamily, but really just telling them like, hey, we're here. Like, I'm working with you. We're working together. You want to sell the home. I want to like work with the person to buy the home. My buyer wants it. Your seller wants to sell it. Like, let's work together to find that. And then just talking about like just saying exactly what they said. Like, they're not going to nickel and dime. We're not even going to do a full commercial property inspection. They're just walking through with a plumber and a contractor to make sure that, if there is major plumbing issues, like they'll look at that. But like usually you'd be doing a lot more inspections on a property and a purchase like this. So that was kind of one of those actions speak louder than words things. When he knew we weren't going further with inspections, that kind of shows him. And then one of the other benefits is that these guys were representing a buyer on the Huntwood property that I just closed, and me and my buyer beat them out. And so he knows that we can bring a deal across the table at least, and that we can get the job done. And so that was beneficial too, because when I mentioned that other property, he's like, oh, we were like we had 3 people competing on that one, and they were one of them. And we beat them out and closed on it. And so I think that there was confidence in our ability, and then confidence in the buyer because they owned multifamily before. Whereas they did have one other person who was talking of writing an offer, but they were first-time multifamily purchasers, which is is a different beast. Right. And so they don't want to get into contract with somebody who's going to fall out of contract. So I think just like really conveying like that you're confident your buyer's going to go across the finish line. You're doing all the negotiating now so that you don't have to do it later. And like, this is what my buyer's telling me. And like, I feel really confident in it. And that was helpful. I think it's really just, like you're working together. I see it as we're all on the same team. Like even the seller side, like on every deal, we're all on the same team. We're all working towards that common goal, which is to get this house sold. So how do we like do that? And that started from the first conversation of like, hey, we're thinking of coming in at 5.4. Do you think your guy will respond? Like, is our starting offer? And when he says like, I think it'd be better if you came in at 5.5, then I worked on my clients to get them to come up to 5.5 for their first offer. So I think it just shows like, we're trying to work together. We're being really communicative. That's one of the things that I think the team does a great job of teaching us to do, is like working the seller is super important, or working the buyer if you're on the other side. But it really is important because they don't know the buyer as well as they know you. Like, you're the one who's having the contact with the other agent. So it's up to you to convey the confidence in them closing and their experience. And that you have, like, when we talked about the 45-day close, that is normally a 60 days at least for commercial financing. So for me to be able to say like, hey, we spoke with the lender confirmed we're good to go with this, like, all that confidence in there is super helpful so that they know, like, if you feel confident, then they should too. And we're not like, who's here to get in the deal and fall out of contract? That sucks. I don't want to do that. Definitely not on a deal of this size. And it takes, I think, like from the last deal I did, like the commercial properties, once you're in escrow, it's a lot more work than a single family home. And maybe some single family home buyers are challenging, but you got to do, like, you're reviewing financial documents, you're doing a hand from all the tenants that are in place to new management company, maybe that's CNC or whoever the owners are. Like, there's a lot for you to review, and it's a lot more work, and the reward is there. But I think, like, for me to convey too, like, hey, I want to be doing this if I like wasn't confident that they were going to pull through here. Because I'm not trying to waste my time here. And Daniel mentioned in here, like, seller finance is usually available, and we do see some of those out here. But on some of these, I think, especially on like this one, the guy had only owned it for 7 years, so the equity wasn't there for him to be able to finance a large portion. And so sometimes, like, we'll always ask. Sometimes if I have a buyer who wants seller finance, it's not a red flag. It's like an orange flag, or what's in soccer, yellow card, right? Because a lot of times when people are looking for seller finance, it's because they know they don't qualify for a few different reasons. Maybe they pay cash in certain ways, or their credit isn't up to par, or whatever. So sometimes it's like, I always ask follow-up questions of why is that important to you? But seller financing is great, especially in a high interest rate environment. And I know, Daniel, you just got into contract with seller financing.
Exactly.
Was that advertised, or did you ask the seller if they would do it?
Advertised.
Okay.
But my buyer was only looking for seller finance just because he wants to get in for little as amount, right? 15% down. and then balloon payment after 36 months, interest only for 5.5%. It's pretty solid.
I don't know, maybe Kevin or Kyle can speak to this, but usually when I see the seller finance options, the sellers are asking for like 50% down. They're asking for a lot more down. Is that like, that seems like a really great deal you were able to find your buyer with 15%.
20 to 25 is what they wanted.
Yeah.
And so they sent us addendum on the specs, the stats that they wanted. And then another line about buyer has to provide all the financial data, for the loan and all that stuff. And so we said, okay, we agreed to point number 2, but we are not agreeing to point number 1. We want 15% down. We want 36 months. And so they wanted 24 months. So I called the agent and I said, hey, if we go one more year, 36 months, that's more money that your seller's going to make. So let's do that. And then they agreed.
Yeah, show them the numbers. Here's what you're going to make over that year of interest.
Yeah.
It is, to your point, Sawyer, very rare for commercial lending to even take anything under than 30% down, in my experience.
Yeah.
And most sellers are not in a position to where they have enough capital and equity in the property to be able to offer, because Daniel, in this situation, they must not have had much debt on the property, right?
Yeah. Already owned it outright.
Yeah, I'm pretty sure it's like 99% paid off. There was a little bit of amount.
Yeah.
So you just got to find those deals, man.
Was the property break even? Was it break even, the property, with 15%?
Yeah, pretty close. Mm-hmm.
Yeah, that's great. I think
it's all about how you talk to them, get it done.
Yeah. I think to Kevin's point, at least in our area, a couple of things. The cap rates usually aren't good enough to justify a buyer putting less than 30% down. And this is more from the commercial financing perspective, not necessarily the seller financing. But then a lot of people are, one of the reasons like they're in multifamily, like they're using leverage to get into these properties, because if the rent roll is high enough, even with a 70% LTV, they are making money on top of that. And so if I go to somebody and say, hey, like I have a commercial listing right now and my seller owes, I think we're listed at 2.5, but he owes 1.3 on it. And we've had a couple people like ask for seller financing. And I'm like, oh, he'll do seller financing, but you got to give him like, he's looking for at least 1.5 down. And so that's pretty substantial. And so people aren't, biting on that one. But I think it all depends on the seller situation. And sometimes they'll be open to that and they can offer it. And it is a good option because you're making money on that interest. And then worst case scenario, you get your property back. It's not a horrible deal as long as it's in good condition. But yeah, I think it is like finding, like to Daniel's point, like he knew what his buyer was looking for and you guys found it, right? And was he always looking in Tahoe, or was he open to anywhere as long as it had seller financing and it was like hit certain metrics?
So Bay Area guy, but he's Sacramento buyer. So he has lots of properties in Sacramento. And then he reached out to me because of Fresno through the bigger pocket stuff. And so I tried to send him some deals. They're all capped at 4%. They're all terrible, all way overpriced. Yeah. So we weren't able to get anything done. And then he just kept sending me properties. Hey, seller finance, call this one, call this one, call this one. And then we figured it all out.
Nice.
And we're good. 21-day close.
Sweet. That's awesome. Yeah, I think it's like one thing that I've really tried to do with investors, because sometimes I'll talk with people and they'll have very specific locations that they're looking at. And if you dig into it, like, oh, why that location? A lot of times there's not a ton of reasoning behind it. Some people are really specific, like, oh, we like this area because we think it'll appreciate over the next 3 or 5 years, or like they'll have like, a lot of those engineers will have very specific thoughts on specific locations, but a lot of people will just be, oh, like that's where I'm looking, or I had a cousin who bought a property here, or whatever the reason is. And so if we could kind of figure out what's the reason for picking a certain location, and then going back to that motivation, it's like, oh, is owning a property in San Jose more important to you than making like more money, or is the money, like, are you looking at the income here? And for these guys, when we talked about the income, then it was like, oh, okay, I can show you these properties here. And then I think they really liked it, but they didn't like the thought of living in San Jose, having full-time jobs, and having to manage a property that was, depending on the time of day, 30 minutes to an hour away. And so that's when the conversation came on of like, oh, could you help us manage this? And they'll make more money with us managing that property than they would on any San Jose property they found. And finding a property with 2 to 3 bedrooms per unit was super challenging. I found 2 in the time that we looked. And it also sucks because there's like, you're not really filtering for that on the MLS when you're looking at properties. I wish you could.
And also, one thing is that guy wanted to buy by the end of the year, so he could do the write-offs. Yeah.
Nice.
Yeah,
We had to be quick.
Yeah, so we put in probably 15 offers within 2 weeks, and finally got one. So yeah, it's basically just learning exactly what they want, what they're trying to do, what's their method, what are they trying to achieve, and then how can I help you do that? And that's just how I did it.
Well, and when you ask them those things, then you know how to, like, not really sell yourself, but then you know the points to speak to. It's just like discovering pain points when you're on a discovery call for PM, right? It's asking questions about, like, what are you looking for? And then you can talk to, here's how I'm going to help you find that, right? If you don't know what they're looking for, then you could be talking about one thing that, like, isn't important to them at all, but you don't know that it's not important. So I think, like, determining their buy box is super important. And I think, like, I'm going to go through my database, and I've got some bigger pockets leads and some people that I know are investors that I don't have a super well-defined buy box, and go through and reach back out and ask them, like, hey, let me get a little more information about what exactly you're looking for. Another point is, like, when you have buyers in the investment world, like a lot of these, like this group in particular, they have a ton of listings and they have buyers too. But when you get known to have buyers and you do deals with them, then they'll start bringing you deals like before they even send out the coming soon flyers, because they're sending the coming soons to anyone who's ever just like downloaded a disclosure from them. But they just had another one come up in Palo Alto, and because we're in this deal, they sent it to me before they released that email, and I got someone looking into it. So I think it's important to establish these relationships and realize that, like, having an active buyer in the investment world is like a hot commodity. And being able to really kind of work the seller's agents and find like the right deals for your buyers is a real opportunity we have. And every single buyer you have, like, there's your person, right? We all want to serve all our clients, but if you have an active buyer like Daniel who needs to close by the end of the year, like, you're my guy right now. I'm hustling for you because you like, that's what your goal is, right? So I think it's something that when we get those opportunities, like, jump on them. When this lender reached out to me and sent me this person's name, like, I called him right away, had the conversation, and then after we talked, I didn't wait a couple weeks and throw him in follow-up boss and wait. Like, no, I sent him properties right away, and then just kept sending them deals until we found the right one. So I think it's important to work these people and to show them, like, hey, I'm out here to search for you and to find for you. And there's a lot of agents that will do it. So that's how we differentiate ourselves. Like, we're really putting in the work to be the boots on the ground for people and to kind of understand the market, which we have unique opportunity to through CNC property management.
So do you do quick math on a property? So let's say you get a deal in your inbox and you see the price, you see the rent. So what I normally do is I'll take the rent, annual rent, then I'll minus the vacancy costs, and then I'll minus 40% for expenses. That's my NOI. Then I divide that by the price. That's my cap rate. That's how I do every single property before I send it to my buyers. Is there something that you do real quick to kind of let them know kind of how it performs and not exactly to make it fast and easy?
I think pretty similar. I like what Kyle shared before. I think he'll take the gross rents and multiply it by 0.58 to get like a general idea. And then I know, like, when I look through these, a lot of people are running expense ratios that are a little less than that. So the 0.58 is a conservative number, but one thing to be aware of is because someone has a low expense ratio, that doesn't mean it's a good thing. That could be like a bad sign. Like, if their expense ratio is super low, there's a reason there's an industry standard. And maybe these people aren't keeping up with the maintenance of the property. Maybe they're skimping because they want to have better cash flow. So maybe you're inheriting something. It's not like, oh, great, this property's in perfect condition. Like, maybe it's worse condition because of this. So conservatively, I'll look at the gross rent, and then then like look at the actual, like see what that is after you multiply it by 0.58. I usually look at the marketing package and then I'll download the P&Ls, because when I send information to clients, a lot of times I'm not actually sending them the marketing package. I'm sending them like the actual P&Ls and the rent rolls, because why would I send them the marketing package from another agent? Unless like I know they're really going to work with me. So that's kind of like the main part that I look at. And then it just depends like on who I'm looking for, because I know like certain buyers are looking at certain things. So if I know one buyer cares a lot about, like I've got one guy, and every time I send him a property, all he wants to know is the operating expenses. All he cares about. Doesn't care about the cap rate, doesn't care about this or that. It's like every time he's like, what's the OPEX? I don't understand it, but I'll send it to him. So I'll send him a property in the high levels, and then in that text or email, it's like, operational expenses is this.
How about this last question? How did you handle the buyer rep agreement? How did you do that? When did you do that? And kind of talk us through how you did that real quick. I know we're running out of time.
So the buyer rep on this, and how I like typically always do it, is property specific when we write an offer.
That's exactly what I do.
Yeah, and so I know like everyone's got a different like way of approaching that. For me, I'm like a handshake deal kind of guy, and like the way I see it is I need to earn people's business. There's no reason why, just because a lender gave me this guy's name, that he's obligated to work with me, but I feel confident in the fact that I will show that they should work with me based on the deals I find them and the way that I present them, and then the knowledge of like the rental side. So just found them properties, and then once we get into like once we write the offer, the BRBC is in there. And I'll explain it a little bit. And they asked me actually when we toured the property, he was like, hey, how do you typically operate? Like, are you expecting us to pay you your 2%? Do you want the seller to pay you your 2%? I was like, well, I want the seller to pay me 2.5%, but I'll see like what I can do. Ended up on 2%. But I think like I always try to tell people, like, I don't expect you to pay me. Like, and I didn't ask them to cover, like when I decided to contribute the 0.5%, I didn't reach out to them and say, hey, will you guys cover this? I just did it. And so, yeah, I think it's, for me, especially with investors, like they have a lot of people bringing up properties. And so I want to make it as frictionless as possible to work with me, which means I'm not going to make you sign something to say like, you're going to work with me in this county if I start showing you properties. And maybe there's been times where people I had one guy who closed a deal with someone else, but that guy brought him the deal that he liked. He earned it. Like, that's, I think that's okay. That didn't frustrate me. It frustrated me that I didn't find it for him first. That's why I was upset.
I just want to add real fast, because I know we have some newer people on the call too. Your local MLS does require you to have a buyer rep agreement before touring somebody on a property, and you can elect to not do it before a tour, but you do so at your own risk. So just wanted to throw that caveat out there.
Yeah, that is my own style. It may not be dotting my I's and crossing my T's.
I have
Good thing with multifamily, you do
we can have newer people on the call, so I just wanted to.
Yeah,
showings or drive-bys with multifamily most of the time. So you can.
I don't disagree. And this property might be on the MLS too. So.
Yeah, and half of them aren't on the MLS. You got to find them on Crexy and LoopNet and other ones.
Yeah,
yep, exactly. So.
Yeah, I agree. No, thanks for adding that, because sometimes I'll say things about my personal style, and people are like, "But wait, that might not be legal." I'm like, "Whoa, okay, I get it." So yeah, but that's the way I handle it. I kind of, I want to earn people's business. I don't want to force them into working with me, no matter what. Because if I don't earn it, I don't deserve it. Right. And that's one of the things that I love about real estate. I wake up in the morning, like ready to go and push, because we're competing against other people to be the choice of the agent and to find people these deals. So thanks for the questions, Daniel. I really appreciate it.
I just want to say great information. And that was really awesome. And thanks for doing that deep dive with us. I thought that was like really insightful and helpful personally. So
yeah, thank you, Sawyer.
Thank you.
Really good.
Appreciate it. Thank you, guys. I'll keep posting these properties. I told some of the LA people on our call on Friday, I'm going to try to start posting some properties in different markets. So it's not just for the Bay Area people. So I'll start looking and trying to find some stuff like in LA and Sacramento. And to the point that I made earlier, like if we have investors, maybe there'll be a deal that one of my investors wants to do down in LA, or you guys have someone who wants to buy one in San Francisco or whatever. And so we can work together on that. So I'm going to start looking for those because I'm trying to present properties all over the place that make sense. So look for those in the coming weeks as I try to understand those markets a little bit more.
Fresno is great for cash flow.
Yeah, I've got a guy looking in Fresno, so I've sent a few over. That they're hard to come by. Yeah. But then, yeah, if someone's got a couple million, they could buy a couple properties out there.
I probably offered on all of them already.
Yeah. But I know who to
They
talk
know me.
to.
They know me now.
I know who to talk to when I got someone looking over in Fresno. But yeah, thanks everybody. Thanks for your time. Appreciate the opportunity, and looking forward to seeing you guys tomorrow morning.
Good stuff, guys. Talk later.
All right.
Thanks, guys.